Welcome, guys. Back to the first series of 2023 schedule. I'm glad everybody could join in. I'm really looking forward to this year's schedule with the training, the technical focuses we have. Again, my name is Matt Young with Flowco, and today I have a guest host, Charlie Jones, the CEO of Flowco. Asked him to join us on our first series this year to give us a little insight.
Thanks for having me on your show, Matt.
Yeah, you bet.
It's an honor to be on the show. I feel like I'm on Fallon.
Well, hopefully I can be as funny as him, but I'm glad you're joining us. And
I've heard you sing. You're not as good as singing.
Yeah, definitely not. But definitely want to get your insight on topic today.
It's worth what you're paying for it.
That's true.
And much.
Yeah. Okay. But we want to have this out here, right? So get everybody started, get us back in the schedule of trying to do these about monthly. First one's going to be pretty lighthearted, as you guys can see. Technical, but not really technical from the aspect of us talking about a specific artificial lift. Just trying to be optimistic about what we think this year will do, and using some historical data to get us there, I think.
Everybody's got opinions like a belly button.
All right.
Here are ours today.
Yep,
So,
definitely. And like Charlie said, it is opinion. We did pull some data to back up that opinion, but if anybody has any different thoughts or questions or wants to argue with us, that's perfectly fine. Let's send it to us either in the chat today for the Q&A, or shoot us an angry email afterwards if you'd like, or I guess call us too.
We're open.
Yep, exactly. So like we mentioned today, just a big kickoff for 2023. This is our third year of doing these e-learning series. I know, right? We started the first one, of course, during COVID when nobody could meet, and really just enjoyed the content and have been able to expand that outside of just gas lift and plunger lift training. And so hopefully this year will be just as successful. And of course, too, this year we can start doing normal training, in-person training again. And really look forward to actually being out in the field doing those kinds of training.
The outlook's fantastic.
Yeah,
no doubt.
So definitely it's going to be a good one. But what we want to talk about today is we're going to do some historical look backs of course, things like rig count, of course, commodity prices, oil and gas pricing. Unfortunately, we updated our natural gas pricing before the big crater, so we missed that, cliff that we've experienced the last maybe 4 or 6 weeks, but we can talk about
everyone on the call is aware of it. I'm sure.
I think so. And of course, duck count, that'll be interesting to see. I'm actually starting to see that tick back up a little bit. And then, of course, any M&A mergers and acquisitions that happened probably late last year, early this year, kind of the big focus, really highlight the basins that have experienced that. And what'll be interesting to see over the last few years, the change in basins that are going through the bulk of the M&A activity.
There's some charts you're going to show that I hadn't seen until a day or two ago that are pretty interesting.
Yeah, definitely.
In terms of the aerial coverage and what this merger means. I don't know if these guys on this call have seen that either, so I'm looking forward to getting some reaction on that.
Yeah, maybe so. We'll see how it goes. And and of course we're going to record this training. We'll put it on the website so you guys can go to if you missed it, if you have to get off early, if we run late and you get bored with us, and you can go back and watch the rest later. So all trainings from past years, from last year on there, and of course any new trainings we do this year, we'll put on the website, and that way you guys can jump on and watch them, and send them to friends or anybody else that might have missed it too. So looking forward to that. And of course, we have some content we want to talk about. Afterwards, we'll have a Q&A session. Hopefully we'll get some good questions. If not, we'll try to make up a couple there towards the end. But if you guys have any questions, just type that out in the chat function, and we'll definitely capture them and ask them as we go through. And of course, if they're really good questions, we'll stop the conversations and ask them. And if not, we'll answer them at the end of the presentation. With that, Charlie, you ready to get started?
I'm ready, Matt.
All right.
I'm ready. I'm looking forward to this.
Perfect. So, like we said, first series of the year, kind of a lighthearted look at the market, what our expectations are. We'll have some data to kind of review with that. Of course, from here, we're going to get into some more technical trainings throughout the year. We'll, of course, focus on our core things like gas lift and plunger lift. If it's just a general 101 to help some of the maybe new hires get back up and understanding of the product line, or if we're going to dive into some more in-depth how to troubleshoot, how to optimize these systems. So the rest of the year will be highly focused and specific on some of the different artificial lift methods. But today is just kind of get everybody started and look forward to the year. And so, like I mentioned, Charlie, some of the things we like to look at gives us kind of an insight as to where the market's going. Of course, the big one's rig count. I know that one's kind of subjective in terms of what that means, but we do like to look at is the rig count going up? Is it going down? Is it staying pretty flat? And being able to look at it not only for North America, where most of us play in, but also the different basins. How were the different basins, affected from the crash a couple of years ago? Have they completely recovered, or at least has the rig count kind of recovered back to pre-COVID days? Of course, big one that we all watch out for, commodity prices. What does that mean from operations and activity? Do we think these things are going to help us increase or decrease activity? And then one of the big ones we've noticed too is DUC count. For a long time, that DUC count has continuously reduced in pretty significant fashion, 5-10% month over month. But here lately, I think it's definitely starting to go in reverse. And of course, we'll talk about some basin trends too, what we see from artificial lift in the different basins. So with that, let's take a look at a few things and go ahead and get started. So guys, what we see here is just a general rig count for North America, really for the US, from late 19, early 2020, all the way through 2023. And of course, this was the fun one to talk about when we first really started these e-learning series, is those big drops like that.
Yeah.
And then this was pretty fun to live through in 2021, 2022, the real big jumps. But it's been pretty interesting that as of, maybe late 2022, it really started to level off. And
now you can see that thing starting to flatten. And, the research that I'm reading, people are indicating that, over the next 2 to 3 years, a lot of the analysts are not predicting it to get back to even 1,000. They're thinking it's going to, they think it's going to rise up to in that 900, 950 range. Matt, I was telling you earlier, one of the things that surprised me was some of the analysts are reporting numbers like this, that like since 2014, the rigs that we have drilling today are drilling twice the amount of footage annually that they were in 2014. So what that might imply, right, is that rig count, if you kind of backdate it in your brain, 8 or 9 years, to where, my gray hair tells me, I want that rig count above 1,000 for sure.
Right.
And we might be sitting at an equivalent net rig count possibly of 12 or 1,300 right now, right? If you actually look at it on a footage basis. So that combined with capital discipline that we're seeing in the market is naturally going to converge in a flattening of that rig count. So I don't think we should despair if that rig count, stays below 1,000 for a while. There's so many factors we'll get into today that I think are really, really positive for our whole industry. Good for our company, but good for our clients, and I think good for the industry.
Okay, that's interesting. So they're almost doing more with less, based off of what you're seeing with efficiencies on the rigs and overall rig count.
Yeah, there's one group out there that I think it was Raymond James was reporting that when you think about, let me look at my number here, make sure I get you the right number. Today, they're claiming we're pumping about 4% more proppant than we were pumping in 2018, but we're doing it with a frac fleet that's 2/3 of what it was.
Wow.
And I haven't, I've just read that a couple of days ago, I made a note. Probably someone needs to fact check me on that. But It just points to higher efficiencies. We're seeing efficiencies across the industry that are just like what we do at Flowco. We're providing value that way. The real question is, are we getting rewarded for that efficiency? And that's what the market's really evaluating all of our companies on right now.
Right. That makes sense. Yeah, that's really neat to see. So, and some of the other things we wanted to capture outside of just rig count is some of the basins. And I know this is a pretty noisy slide. We'll get into some more details in terms of the different basins. But really what we see from this slide is that almost all the basins have started to plateau, very similar to what we saw with just the general rig count. And we're noticing that for both, of course, some of the oil basins, and then also some of the natural gas basins as well. Very similar, slope change where it has flattened off. Of course, a lot of those haven't been such a dramatic rise in rig count like we saw with oil. But also thing to notice too is, back in early 2020 when rig counts were really taking a beating, a lot of the natural gas basins didn't take, from a percentage or total number drop as bad as you saw in some of the oil basins.
And I think, I was trying to interrupt your net, Matt, but I think I read that the net kind of cash flow break even for most of the shale operators in North America is around $61, $62. And so when we look at that oil price, where is it right now? 75-ish?
Yep,
roughly
mid 70s as of this time. Yeah, high 70s.
So I was looking at the future strip last week. I don't know what it's doing today, but I think the future strip out into July or August was still at 75, $76. Yet there's a lot of industry pundits out there right now saying that because of the economic situation we're in, the political situation we're in, the supply-demand situation we're in, that there's quite a few that are saying that they expect oil prices to be approaching $100 by the end of the summer. So we'll see. We don't do oil prices at Flowco. We try to help you with your production so you get the benefit of it, but it does drive our business. And so we try to, so in Q&A, anyone's got any opinions, I'd love to hear what they can share with us today.
That's really interesting. And, one thing I wonder about that too, with those change and oil prices is, what does that mean for the operator, back to that capital constraint, the ensuring cash flow goes back to the shareholders? Does that just mean more cash goes back to the shareholders, or do they follow it more on a percentage basis and still allow them to grow as they see that commodity price grow?
Yeah, let me share some color on what we're thinking about that. When you look at the free cash flow yield across the market, so if you look at your the cash you're generating versus the enterprise value you have on your business, the number for energy service companies, E&P companies, and even the major public E&Ps, the yield is currently between 10 and 12%. And when you look across the market, for example, I believe you go look up the Russell 3000 right now, that yield is more like 5%, half, right? And if you dive into healthcare or industrials or any of the other, even tech, if you go and look at those yields, they're like 5%. So what's happening? Yeah. So what's happening is we're now, our clients are generating much higher yields, and they've been giving those yields back to their shareholders.
Right.
And we've been hearing that the capital discipline's there, but at some point it becomes more popular to divert some of that to capital, and you need to do that
to ensure that 10%
you're in the business,
can
right?
continue.
Yeah,
right.
you could just, it's like our company, we had a board meeting yesterday and we're talking about capital allocation right now.
Okay.
And it's I'm sure there's many other companies having those discussions right now too. And I think the situation today is very different than a year ago, because we have had a year of better commodity prices and better earnings. The other thing is, just to quote another little factoid, that since 2015, I believe it is, we saw in just the energy services space that we're in, we saw roughly, I think the number was 293 bankruptcies since 2015. And what drove those bankruptcies were as EBITDA fell, people had been leveraging
Mhm.
to grow and spend that on capital, and they got out of whack, and their leverage got up to a net average of about 6 times leverage. So if you're earning 10 million a year, and
Mhm.
you're carrying 60 million of debt, it takes you 6 years to pay it off.
Right.
Well, that leverage is inverted now. The EBITDA has increased and people have been
kidding.
paying down debt. And the net average in energy service today, and these are the ones that are still standing after we lost 293,
Mhm.
right, is 2 times.
Wow.
So, and that cash comes from the people on this call, our clients, right? So they can't do business with us if they're not doing well too. So I think it all trickles uphill to that the political environment, the economic environment is very good looking going forward. And that's why we're making investment.
Right, right. That makes sense. And yeah, and that's encouraging to hear. And, if we look at it from, I'll jump over to this slide here just to reference the commodity prices, then hopefully we'll have a flattening or, like you said, kind of that long-term
We need stability.
growth. Yeah.
We just need stability.
You're right. And I mean, last time we really had stability was what, late 18, early 19 before it started to approach this. Was if we extend this back a few years, it looked pretty bad from 19 in terms of pricing. So yeah, I agree with you. And this is one thing that's neat too, is what we're looking at here is duck count.
It's inverted right there.
Yep.
It's starting to invert.
It really is. And
that's indicative of what we're talking about. Right.
Yeah. And one thing that, again, outside looking in, that I wonder too is with this count growing here in the last few months, is that like tier 2, tier 3 drilling acreage? Is that not like the core best production, best drilling? And so, are they finding that out after they drill the well, or are they knowingly drilling maybe tier 2, tier 3 production, looking at the economics of it and deciding not to complete those wells after they've actually drilled them?
Well, we've got coming up in some slides, some things that you guys have been seeing that are kind of, they give you an indication, a corollary answer to that. So we won't spill the beans at the time.
Yeah, okay. Yeah, we'll look at it.
Well, but yeah.
Yeah.
Yeah, we see some things. So yeah.
All right, I like it. So one of the things too is just like to share this information. I'm sure most folks follow this this type of data, but it's good to kind of compile it together and do a look back. I know it's all historical, but it's really great to look at, really see how the industry's changed since that really post-COVID
we're back,
drop,
right?
Way back. Yeah,
we're back.
No kidding, we're back and doing well. And I think most operators are, in that same boat. Oh. But one thing that we wanted to talk about too was specific basins. So we're looking at this from like a North American viewpoint. But secondary to that, want to look at some of the, important, most active, larger basins in North America. And one that's been really nice to see, especially here lately, has been the Bakken. Of course, you can see here on the basin slide, Bakken really took a beating early on in COVID and has kind of lagged all of the other basins in terms of recovery. And I think, in my opinion, I think a lot of it is twofold. One, it's up in North Dakota, it's in the middle of nowhere, right? So it's hard to stage equipment, logistics of getting personnel up there, and kind of couple with that, it's very expensive to operate.
That's what I was going to say. It's probably the first to fall and the last to rise, just because of the delta on costs.
Right. And so it's been really interesting to see and really to see how artificial lift in the Bakken has adjusted to those factors, right? Is that, of course, ESP and sucker rod pump are still king up there in terms of production. But we're starting to see a shift from that, either because of flaring regulations or new completion having to deal with the flow back of the excess frac sand and the frac plug debris that were maybe left in the wellbore after clean out. And so we're starting to see things like operators utilizing gas lift early on in
I know,
the
it's
well
amazing.
completion,
Yeah.
just to clean the wells up.
Yeah.
And then switch over to ESP, and being able to extend that ESP life out before they have their first or their initial ESP failure.
But economically it makes sense, right? You've got a big investment in an ESP in that installation.
Right.
And on a relative basis, a gas lift completion is, so economic, right? But it's in a weird way, you and I were talking about this last night. That's kind of a weird thing, isn't it?
It's strange to see gas lift to ESP.
Yeah.
Usually it's the inverse, is that ESP to capture those IPs, capture those higher rates, and then maybe after the first or second ESP fail, then switch over to your gas lift application. If it's in that range of that it's too high of a production for sucker rod pump, but too low for the ESP. Yeah, so that was an interesting one we've noticed over the last few years.
Oh, I'm loving Q&A, but my own line's got experience with that or what they're thinking. We'd love to know more.
Yeah, definitely. I agree. And another thing that's been really neat, more for the later life production, some of the aged parent wells in the Bakken, is plunger assisted gas lift applications. Again, sucker rod's king on some of these late life producers, but in some of the higher formation GOR areas where, again, they're having a lot of rod pump failures, going over to plunger lift on pretty low rate wells. We're talking sub 200 barrel a day type wells. That's been really interesting to see. And because ever since development, it's ESP and rod pump and all their production. So that's been a fun one to work in. I'm really glad to see activity levels finally starting to recover. It seemed like it took a long time for that basin to get back to where it was.
Yeah, and your last bullet there on the cap tubing and the chemical injection needs, I mean, we've been seeing across the whole business increased adoption of that.
Yeah. And, from my thoughts about that in general is the cost of tubing, how much tubulars have gone up and
if you can get them.
Right. And so hopefully with that, addition of chemical or, direct injection of the chemical at the bottom of your tubing string, hopefully you can coat that tubing string and extend that life a little longer before it fails due to corrosion. Because that's a big one in all basins right now we're seeing is either erosional damage or corrosional damage to the production tubing, where systems are lasting maybe 12 months in some areas if you're lucky, and it's not just a fail joint of tubing, it's a quarter, a third of the tubing string that has to be replaced. So let's look at some of the other basins out there. So we grouped Rockies together. Really, this is going to be your Powder River, your Niobrara, and your DJ Basin there in northern Colorado. So that kind of eastern Wyoming, northern Colorado basin. And again, this one that saw a big drop early on, but tended to recover a lot quicker. And my thoughts for that is a little closer to the markets that they have, the oil and natural gas shipments. Well costs are probably a little less expensive, especially in DJ, just due to the shallow well bores. But this one's been pretty neat. It covers all artificial lift, right? Is that in DJ Basin, it's primarily plunger lift, pretty high formation GOR type wells, kind of wet gas wells, if you look at them, or gas wells with some condensate. And then you move up into your Powder River Basin, a little higher liquid yield, tends to have a little higher bottom hole pressure. So you see your gas lift and ESP as your primary or first artificial lift, just to be able to get those higher IP rates. So been a fun area to operate in. Of course, the politics of Colorado are always a little iffy in terms of some of the regulatory things that state's applying to the oil and gas operators. And from our opinion, what we've noticed with that is a lot of people just move up to the state line and operate in Wyoming, which isn't putting as many restrictions as it seems like Colorado does.
Yeah, you touched the live wire with me when you said the politics, because so much of the capital discipline that we're seeing right now is driven by politics.
Yeah.
And we've got to get past that as a nation. We got to get past that.
Yeah, I agree.
Fossil fuel is going to be around a very, very long time. And at the end, I hope we get to talk about, quote, the energy transition, because I got some opinions and some facts I want to just throw out there so that we can get some Q&A maybe at the end.
Yeah, I'd like to see that. And I read Chris Wright's article from Liberty Energy.
Great guy.
And that was pretty interesting. And his approach was not, I'm sure I'll screw it up, but not net zero at 2050, but energy independent at 2050, meaning that everybody in the world has, access to cheap, affordable natural gas and oil to help power them and really get them out of poverty. So yeah, look forward to that.
One of the factors I'll go ahead and share, because you kind of mentioned the natural gas, but a lot of these models, we've got the model in the United States for this transition, and you can go find them online. And then different governments have their models. So there's a European model, an Asian model, even China has a model.
Oh, no kidding.
And you can find them. And what's interesting is when you look at those models, most of them, except for China, but the U.S. model models different countries. So when you look at the U.S. model, it predicts that coal consumption will go down dramatically, right? But not in China, right? Which is a huge consumer of coal, which leads to the whole issue that everybody's, talking about. But the interesting thing is that if we saw the decline in coal that some of these models are requiring, just replace that energy, because you need to double 2.5 times the amount of gas in production to cover that.
Really?
Right. So you're going to use coal to make electricity. You're going to use natural gas to make electricity. So it's complicated. We'll sort it out, but it's going to be expensive if we keep on the path we're on.
Yeah, I agree.
I'll shut up. I'm sorry.
No, this is great input. I mean, this is what we want to talk about. And, really what we're seeing both from an activity standpoint and then some of the other things that really affect that, because I don't know if other people experience the same with me, is I just get so hyper focused on my little piece of it that a lot of times I don't raise my head to look up and see what's going on surrounding. And it needs these kind of conversations to really get that out there. And of course, one of the big basins, the basin that everybody wants to work in and everybody wants to talk about is your Permian and Delaware Basin. And this was the one that really recovered the fastest and continues to be the most active, especially if you look at like total number of rigs in the Permian, it's half of the total U.S. rig count, right? So it really shows what's going on. And of course, if anybody's had any experience out there, you biggest producers in terms of production and the total volumes that you're seeing out there. And one thing that's really impressed me, especially in the Delaware Basin, is the amount of gas that comes out of these wells. So not only do you get 2, 3, 4,000 barrels of oil, you get 8, 9, 10 million a day gas rates out of these wells. So definitely has the interest from everybody. With, of course, the stabilization of commodity prices as compared to like early 2020. One thing that I've noticed that is pretty interesting is the switch back to ESPs in some of these higher productivity areas. And the fact that some operators are actually starting to drill bigger cased holes, going from 5.5 to 7 inch, just to be able to extend the life of the ESP or possibly put a bigger ESP in the well to begin with, which is interesting because back here, we were spending a lot of our time converting from ESPs to gas lift. And now we're starting to see during this time frame here, initial artificial lift is ESP. And so I think as this kind of trends on, we'll probably re-experience that ESP to gas lift conversion, maybe after the first or second failure. But we're starting to see that deferral of gas lift installs in place of ESP installs, at least on the first artificial lift. But this one's also, in my opinion, kind of driving the not necessarily experimentation, but new technology development in the artificial lift. You see a lot of information about single point gas lift with a big gas lift compression. So that's being driven out there. Of course, different ESP applications, different gas lift applications. It's really neat because you're seeing a lot of the kind of new technology go out there and test. And I think they have the capital and the patience to try out some of these.
It's like side pocket mandrels getting used.
Yep.
Right.
Yeah.
I mean, it's just, you can see that adoption of derivative technology happening as you chase that IP.
Exactly. You're right. And I mean, shoot, side pocket mandrels, that's primarily been a offshore market application, but you're right. There's been a wider adoption of that in the Permian and more particularly the Delaware Basin over there in New Mexico and Texas Panhandle. So that's been really neat to see. That piece has been interesting to see just from the training and the understanding of how that works and the expansion of services, training the slickline guys to understand the operation of it, setting procedures in place to know how to go and make those changes with slickline. So another area that, again, really took a big beating, and one thing that's interesting, and maybe this goes back to some of the efficiencies, is MidCon. So that western central Oklahoma, that they're actually back to a better rig count than they were pre-COVID.
Yep.
And again, I think with some of this is really pinpointing some of those core acreage in the scoop or the stack production and really finding that tier one production and then doubling down with a rig count on that tier one production that they've been able to locate.
It's kind of pinpoint rifle shot possibly happening.
Yeah. So this has been very interesting to see and very similar to some of the other basins, different forms of artificial lift. Again, kind of the big one is your conventional gas lift in most of these new completions. In some of the higher pressure applications, they've actually been able to defer gas lift and go straight from natural flow to plunger lift, similar to what you see maybe in the DJ Basin, but their kind of core artificial lift still continues to be that conventional gas lift. Production rates where your tubulars can handle them, even on your IP production, and really maintain that long life production with gas lift. Let's see what other basins we have. Eagleford, another really great one to look at. Last year and a half, really have recovered from a rig count standpoint. This is one that I've noticed, and I think we'll be able to talk a little more in the M&A activity, is operators focusing on some really core assets, picking counties, picking areas, and really focusing all their production on that, almost to the point where it looks like they're maybe divesting some of their non-core acreage down there in the Eagles.
There's been a lot of M&A in this area for sure.
You're right. There really has. And that's been one interesting piece to look at over the last few years is how that M&A activity moves around. 2 years ago, the majority of it was in your Permian Delaware Basin, where all the activity was going on, right, with the ConocoPhillips and Cimarex and all that. Well, then it shifted, it seemed like, to your gas basins in 2021, your Haynesville and Marcellus. Well, 2022 and early 2023, it looks like all the activity is shifting down to the Eagleford, and we'll be able to reference some of that in a few slides. But that's where it seems like the focus has really been on that activity. So, and this one's been really neat. One big piece that we're seeing, especially for some of the brown areas, the older production of the Eagleford, is the implementation of plunger assisted gas lift, primarily just for gas consumption, just trying to reduce how much injection gas they're sending to the wells, for a multitude of reasons, but kind of the two big ones we see is either an allocation, take that gas and allocate it to higher producing wells, so use that gas more efficiently, or in other cases, the operators are paying for that gas, buying it from a midstream, and simply by reducing the buyback gas, less money they're spending on the wells to produce. So that's been really interesting. An activity level from us has really shifted, where a bulk of our work a few years ago was gas lift in the Eagleford, but now it's 50-50 split between plunger lift and gas lift. And again, all of that development of plunger assisted gas. And so that's really been fun. There's some great data coming out of that from a modeling standpoint, some really good papers coming out on that, that we're seeing that, really being able to identify a model production change in injection gas when you convert over to that plunger assisted gas lift. So that's been really neat to see. Few operators down there are doing a really good job driving that. Another big area is our gas plays up in the Northeast, that Utica Marcellus. Definitely a different trend in rig count, not as dramatic drop and regrowth. Those areas tended to, in terms of, activity, they seem to kind of ride that through. And my guess is because natural gas prices were kind of always depressed in those areas for the longest time. And this one's neat because, of course, you have the benefit of like a high pressure, high gas flowing well. So artificial lift, at least early on, really isn't needed. But as those wells age out, we find like plunger lift and capillary tubing tend to be the two kind of primary artificial lift methods. A lot of development in compression used to simply like lower your wellhead pressure is starting to show as kind of your long-term artificial lift methods up there. But great area to see. If anybody hasn't been out there, Pennsylvania and northern West Virginia and eastern Ohio is absolutely gorgeous, like going out there. So one of the other gas trends or basins that have really picked up has been that the Haynesville. And here we kind of highlight Haynesville and the Barnett, but primarily focus in that Haynesville, that area up in northern Louisiana, and the activity up there, and really just the activity of the wells that they're completing and bringing online. Every time I see a drop in natural gas prices, I understand when you go and look at the productivity of a Haynesville well. They're absolutely impressive. And for a long time, really don't utilize any kind of artificial lift, just because of the pressures and the volumes that they're flowing. But you do see some artificial lift in this weird area between casing flow and tubing flow for Haynesville. And the Haynesville they get stuck in this area where the well cannot flow naturally up casing because the production rates are starting to decline. But if you go and put tubing in the well, you restrict it so much that you get this like stair drop production change. And so operators are trying to find,
because you got this step function,
exactly.
It's really hard to tune.
You're right. And you have to find that area where you can casing flow it or extend the life of that casing flow. And you're starting to see a lot of capillary tubing actually installed just inside casing to help extend it, cover that window that's not really casing flow, but not really tubing flow. So then as they pull it down another 6 or 8 months, then they can tube it up and not lose that production due to the restriction. So that's been a really neat area too. But, for time, I want to kind of jump over to this, get some responses, both from the audience and Charlie Jones, but want to kind of talk about some of our mergers and acquisitions. And like we said, one of the big areas that we've noticed in late 2022 going into 2023 has really been the Eagleford. Some of the biggest M&A activity in 2022 occurred in the Eagleford. And of course, I think Marathon and Ensign kind of kicked that off. That was the big announcement for those guys, a $3 billion all cash deal to acquire Ensign, picked up over 130,000 net acres. And it's really neat too to see how a lot of their production overlap in some of Marathon's really core acreage.
That overlay is neat to see.
It really does, and I like it. And so you can kind of see some of their core acreage and maybe some outliers. Maybe this is some exploration work that they're going to do, or heck, maybe they divest some of that off to somebody else if that's not in their core business. But
These guys never divest anything. A joke. You'll see in a minute.
Right. Yeah, no kidding. Hopefully Marathon does it better than some other ones. But
let's not get critical.
But it is neat to see. And you'll notice with all the Eagleford ones, the overlap in that core business. I like this one. I think Devin did a great job picking up Validus, kind of adding that net acreage back to some of their core areas. I think Validus did a great job too, because Validus acquired this acreage from Oventive for less than 900 million about a year ago.
Yeah.
And flipped it over to Devin without drilling a single well, I think, at 1.8 billion. So congrats on both companies. Devin picked up a great asset, and Validus did a hell of a job of flipping that in less than a year. Another big one is Chesapeake announcing that they're shifting away from oil, divesting their oil plays, kind of going back to their original natural gas focus when they had started in early 2000, becoming 100% gas play. It's rumored that their sale of both their Brazos Valley up here in the north and their Eagleford down here in the south worth about $2 billion. A majority of that was sold off, this Brazos Valley piece up here, Charlie, to a company called Wildfire for $1.4 billion. But what's interesting about that is Wildfire originally sold that acreage to Chesapeake back in 2018 for $4 billion. So they sold it to Chesapeake in 18 for $4 billion, bought it back 5 years later for $1.4 billion. Exact same acreage that
and on the asset.
Yep.
So you net the difference and you own the asset.
Exactly. Yeah. And I'm sure Chesapeake probably drilled a couple wells for them too.
Made it better.
So again, Wildfire, Wild Horse previously was their name, did a fantastic job getting back in, getting their asset back and really developing it. I'll be interested to see who picks up this Eagleford asset down here in the south. That'll be a good pickup, good acquisition for somebody. So that's kind of the big Eagleford, right? Mm-hmm. That was the big focus. Of course, there's always M&A activity going on in the Permian, Delaware. This one was pretty neat. Centennial and Colgate merging together, forming Permian Resources, publicly traded company. And so you can see really great overlap over in this area, helps them kind of expand out into their New Mexico, Delaware Basin activity, but really great overlay down here, and then just picking up some of that extra acreage. Of course, over in Lee County, if you ever look at rig map, most active, in terms of drilling right now out there in New Mexico. So that's a good one. That good group of companies to see merge together. Another smaller one, but really Earthstone starting to step up. I think this is like the third acquisition in probably 3 or 4 years, as they picked up a portion of Titus in oil and gas. And so again, gave them some expansion out there in that Delaware Basin, really get some more acreage to develop. And we're able to both get their Delaware and Permian acreage out there. So good to see some of these smaller acquisitions still going on out there in the Permian. Bakken was another one that really started last year in terms of acquisitions. And I think as we shifted down to the Eagleford in late last year, I think we're going to start to shift up to the Bakken this year and start to see a lot of consolidation up in that market. And a good merger was between Whiting and Oasis, and now they formed a company called Chord Energy. Just a little FYI, I looked that up thinking that that was named after the music chord. It is not. They actually had to define why they named it Chord, but it's not for music reference. But yeah, that was a big one. There's rumors that there's going to be another big acquisition up there, with Chord possibly purchasing somebody else. So kind of see how that goes this year. And then I think one of my favorite ones is Continental going private.
Man, that's a bet right there.
It really is. And I know
Harold
you mentioned
Ham,
it yesterday.
Yeah, he's going along for sure.
Mm-hmm. And so what does that say for the market when you have Harold Ham, because he took his family money and some investors, right, to take that private?
Yep. That's a big bet.
Mm-hmm. A bet that he expects commodity prices to stay stable and increase, and really has a big play in some of these basins. And, of course, Continental has expanded not only in the Bakken, but they have MidCon assets there in Oklahoma. They picked up some Permian assets too out in West Texas. So, and actually they purchased Chesapeake's Wyoming assets too in the Powder River. So they're becoming a pretty diverse operator in some of the big key oil and gas basins that are in North America.
Let's stop on the number there, 27 billion. It just needs to be said. I mean, we know the math, but that's $27,000 million.
A lot of zeros.
That's a lot of zeros.
Yeah. Yeah, so I like this one. I like following what Harold Ham does, and he's done a good job of really expanding in some of those basins. And I'll be curious to see if that encourages some other private oil and gas operators to go public, or to go private, excuse me.
Yeah. In fact, that may be something we see because of this kind of lack of, the public market not necessarily rewarding being public and being an E&P, and the constraints that currently come from being public in terms of optics and other stuff. You see guys out there, like I'm suspecting here, they've had enough of that, and we're just going to take it private, and we're going to run it for what it should be, which is an enterprise, a financial engine, a business, and quit worrying about all the politics and optics and all the regulations that really don't add value to the business.
Do you think a lot of the ESG things that people talk about, especially from a publicly traded company, might be driving some of that?
Well, yeah, I do. I mean, you're starting to see the public companies. I saw some research a few weeks ago where people are monitoring how much ESG comes up on a quarterly conference call with a big public E&P.
Really?
In terms of how many times they say the word,
right?
Such as metrics. And it's definitely declined. It's still there. It's going to be there. And there's a lot of elements to that that are very important. We've struggled with that at our company, honestly, because we're trying to figure out what the right balance is going to be. We're trying to lead the bird. We're trying to set a trajectory where we hit the bird and we don't just react to the near-term need. And I think as you're a public company, you got it compounded dealing with that problem.
I see.
So it is moderating. You can go find people online that are actually setting up funds that are kind of counter ESG in their thinking, and there's a pretty vocal group out there, with that. I don't know Harold. I've never met him. To me, he's just a media guy. I see him on the media. But the one thing I kind of look at him is a little bit of a character in terms of he's decisive, right? And he's controversial, and he makes big bets. And I think that's what we're missing in the oil patch. I think a lot of those guys over the last 15, 20 years are not around anymore. And this current situation where we got this tension between capital allocation and expansion may produce some of those guys. So our friend at Lewis might be one of those type guys, right?
Right. Yeah, so, jumping in and kind of filling that void.
And that's what built this industry. Let's get on with it.
I mean, you could be that.
No, I'm not that guy. Definitely not that guy.
So yeah, no, that's really great insight, and it's real interesting to see this. So I'm curious to see how Continental does, and like you mentioned, if some of these other companies really start following their lead on that.
Yeah.
But yeah, I mean that's the content, right? And from here, really just wanted to kind of talk about what we reviewed, what our expectations are. Of course, if anybody has any questions, definitely happy to answer that. But while we're on this subject too, just want to talk about some of the future trainings. Of course, this was the big one to get us kicked off, right? From here, we'll actually start getting into some technical discussions, gas lift, optimization, utilizing nodal analysis and some of the different optimization softwares, plunger lift, utilization of that cap tubing and downhole gauges, and kind of wrap up the year back in the plunger lift. A little more advanced troubleshooting, optimization on plunger lift, and that implementation of plunger assisted gas lift, where we're really starting to see across all the basins. And of course, these are just our e-learning series. With this, this year we're kind of open back up to be able to do full field trainings with operators, back to doing 3-day gas lift schools that maybe we were limited, especially in some areas like Denver where we were really restricted last year and big people gathering type training. So looking forward to this year because it will be the year of training that we've missed out on the last few years, and being able to get back out on the road and do a lot of in-person training. So looking forward to that.
This training thing that you guys are doing from, what we're doing here online as well as in person is something that fundamentally the company highly values. I want to tell you right now, thank you for what you and your team do. Yeah. And we recognize it. And it's definitely in alignment with what we want to become. We want to be industry experts. In many ways, we want to be agnostic. We want to give you the right solution for your situation. If it involves us, great. Yeah. If it doesn't, but it does you good, then great.
Yes, sir. And that's where we approach it, is that we've got a lot of great engineers here, petroleum mechanical engineers, that they can put together the work, put the reviews together, and pick whatever works best for that well.
Yeah. And that's how we hope to retain your business long term. When you need us, we're the guys to call.
Yes, sir. That's great. Well, thank you, Charlie. Robert, do we have any questions? Okay. So yeah, a few things, with this, I think the big piece is like what we see with the market, right? And so looking at some of the expectations and things that we're experiencing now is like, Charlie, from your perspective, what do you think 2023 is probably going to be maybe our big pain point or restriction? And then kind of what do you think from a positive side that you see going into this year?
I kind of see it as a rubber band that's got a lot of tension on it.
Okay.
We've got the capital markets applying a lot of attention for companies to take their profits and give them back to shareholders. And that's been unprecedented in our industry for decades. And our reinvestment rate in the industry got up to where net average people, we're reinvesting at a rate of like 120%. So what that means is you're taking all your profits, plus you're leveraging your business and you're reinvesting, and that's really what went on for decades. Okay. Today, the reinvestment rate for the larger publics, where we can see the data, is 20 to 30%.
Oh, wow.
Yeah, it's really, really fallen because that difference has been going back to shareholders. And I think that's going to collapse. We expect it to collapse, which means when it collapses, when it decreases, that means that percentage is going to be going towards capital allocation that becomes, quote, politically okay to do and supported by the shareholder base. Because there's going to be people that flood, and I'm talking about the public companies, it's too hard to see with the privates.
Right.
But there's going to be dollars then flood in for people that are like-minded to buy those stocks, right? And when they buy those stocks, those valuations go up and it starts the engine again. And I think this is the year where we're kind of getting the race car out of the pits and we're kind of slipping the clutch and we're trying to figure out where first gear is. And, people talk about margin expansion, and we've had all these cost problems across the industry, supply chain disrupted for a couple of years. And we're starting to get our grip. The problem is inflation and the bad press that our industry is getting related to that from the current administration. And it's blocking a lot of people's ability to go and invest in stuff like that.
Obviously.
So the rate of it, how how that rubber band that's being stretched kind of comes back together and that money starts to flow again. This is the year.
Okay.
So,
and with that capital back to the shareholders, do you think that'll be a big piece that drives some of these maybe new investments, or
I think that's
more
going to
people?
shrink. I think there's going to be those investors are going to be more okay with getting less absolute dollars because these companies are going to be earning net more money, and they can look you in the eye and go, look, I'm still sending you some money, okay, but this is a great business and we need to be investing in it, right?
Right.
And we haven't been investing in it. There's pent up investment needed is my point, and we need to get back to that. And the risk they run today is if they, I say today is probably wrong. Last year, if you're a public company, you tell people that it wasn't popular. And so they would bail out of your stock and it would fall. But today it's becoming more popular.
Right.
Right. And it's going to be changing, we think, this year. So we'll see what happens. How far it goes, who knows?
Yeah.
Let's hope it happens. It needs to happen.
I agree. Well, that's good to hear. And yeah, and like you mentioned, from the cost standpoint, hopefully we'll see some of that stabilization in cost, because I know everybody's experiencing that, not only in the material standpoint, but the labor and just simply cost of logistics to get from plant to service center out to location, or just getting people out there. It's becoming both painful from a hiring standpoint and also the cost it takes to support that person.
Yeah, and the compounding effect of inflation, if let's pretend inflation was flat, and of course it affects borrowing ability, it gives you more borrowing ability, but it also means if it's flat, I still think net average, we all agree on this call that we expect energy prices to go up, because the facts are we can't go to electric tomorrow, and we're not going to go to electric tomorrow. And it is going to be expensive to make the conversion, but if you add inflationary effects on top of it, it just really gets nasty.
Yeah.
So we'll rationalize it. We'll figure it out. We'll see what happens.
That's good.
Yep.
Well, heck yeah. Well, thank you for being on today.
Pleasure.
It was a great.
Nice to be on Fallon.
It was great to have you here, and great for your insight, especially for this topic here. And guys, thanks for joining. And of course, if you have any questions or feedback, please give us a call or shoot us an email, and happy to keep this dialogue going. So with that,
Pleasure
thank
being
you
here.
guys. See you next time.
Bye-bye.